All right, so futures are trading until 9:15 a.m. Eastern time. Markets, of course, are closed today for Good Friday. Right now, there are Dow futures. As you can see, we've actually come back over the morning. Again, this will give us a sense of where we're going to open Monday. The bond market wraps up early at noon today. John Lonsky saying he's watching the bond market today to see how the reaction is going to go with regards to jobs. Let's take a look at oil and where oil actually settled last night, surging over 11% on Iran escalation fears. Brent gained 8% as disruptions through the Strait of Hormuz are keeping supply concerns in focus. Brent spot prices spiked, physical cargoes surging to more than $141 a barrel. That's the highest level since the 2008 financial crisis. A French-owned container ship did exit the Strait of Hormuz. That's the first Western-linked vessel to do so since the start of the conflict. Meanwhile, Amazon adding a temporary 3.5% fuel surcharge for third-party sellers, driven by higher energy costs and shipping expenses. That could push prices higher for consumers. Let's bring in Allianz Chief Economic Advisor, Wharton Professor, and Gramercy Funds Management Chair, Mohamed El-Erian. Mohamed, it's great to see you, sir. Good morning.
Morning, Cheryl.
Your thoughts as to what you're seeing play out right now, just not concerns about the global recession, but also the price pressures that we're really beginning to see here in the United States.
So in the U.S., it's all about prices. Round one was higher energy prices and higher mortgage cost. Round two, which you just referred to, is we're starting to see prices spread out in the economy, and we may see higher cost of living. Compared to what's happening to the rest of the world, we're in a much better position because we don't have to worry about actual quantities. We don't have to worry about shortages. If you go to Asia, the concern is not just about prices, but they're really worried about quantity. So they're starting to slow down consumption, and they're going to sacrifice some growth as they try to manage through this energy shock.
What if the conflict goes up to 2 months time frame? In your opinion, what does that mean? And is this a point where it's a point of no return, if you will, for the economic effects that we're going to see?
I mean, it's not a point of no return. There will be a return at some point, but it makes the return further in the future. Round three. So round one, very focused energy prices, mortgages. Round two, much broader cost of living hit. Round three, and I hope we don't get there, but if this conflict goes on for 2 more months, as you mentioned, if that happens, and I stress if, then we're going to also see lower growth. We're going to also see higher unemployment, and people are going to start worrying about financial instability because you get what's called credit risk in the system. Yeah. And these things are cumulative. You don't go back, you keep on building on them. But as I say, the U.S. is in a much better position. The rest of the world is already worried about phase three in a major sense.
Well, that's why the president is called on, these allies to step up to the plate and deal with the Strait of Hormuz, and they need to get it open. Europe's economy is so much more impacted than our economy because we're a net exporter of oil here in this country. Let's move to the business of the day with you. The March jobs report is out in 10 minutes. We've got economists expecting 60,000 non-farm jobs. The unemployment rate is expected to hold steady at 4.4%. We had that surprise loss of 92,000 jobs for February. Mohamed, what are you going to be watching in this report that's coming up in 10 minutes?
So first, I'm going to watch the numbers you have on the screen right now, because as you point out, we had a weak February and we had a strong January. So this is going to be the arbitrator, if you like. And if these numbers materialize, it will tell us that the labor market was in a good place going into the war. And that's important. You want to know what your initial conditions were. So that's the first thing I'm going to be looking at. The second thing is, where is the job growth coming from? Is it concentrated in healthcare, or is it a much wider phenomenon? That's important. And finally, there's this tension between supply and demand. We've lowered the supply of labor because of migration policy, but we can't figure out, are we settling at a much lower level of job growth because the supply is low or because the demand is low? And that's the third thing I'll be looking at.
Okay. Real quick before we take a quick break and come back with you for the report, I do want to ask you about private credit because stress is building in the space. Outflows are accelerating. Sentiment's negative. Blue Owl Capital is now limiting withdrawals to 5% after a surge in redemption requests. And investors are looking to pull more than $5.4 billion from 2 of its private credit funds. I mean, the pressure's mounting on the sector. There's AI-driven concerns. There's broader volatility, Mohamed. What do you make of this true shakeup in the private credit space right now? And are you concerned?
I'm worried about the firms themselves. Blue Owl, for example, the numbers you've mentioned, one fund got redemption requests that were equal to 41% of the fund. That's enormous. They will only meet 5%, which will make investors even more nervous. So there is a liquidity squeeze going on in some of these funds. I want to stress some of these funds. As long as I can avoid a credit hit, and that's why the bigger economy picture is so important. As long as I avoid a bigger hit, that's a focus shock. Right. But if we get a bigger credit hit, you're going to be asking me about the systemic effects.
My mind was already going there. But to be continued, Mohamed, you're going to stay right there. We're going to be right back with our jobs panel. You're watching Mornings with Maria. We have now got 8 minutes to go. Stay with us.